Alright, hey everyone, and welcome back to Lunch at the Market. Wow, what a heinous day on Friday. Positions like Molycorp, Deckers, Southern Copper, and others went from being just fine at the beginning of the day to basically burning to the ground by the end of the day. So we had to roll down and out on quite a few of our positions. Last month was not our favorite, or technically it's still January, right? But it was not our favorite month of options expiration. We are much more looking forward to February than we were for January. All right, that being said, both Salesforce.com and F5, right? CRM for Salesforce.com and FFIV for F5 Networks are both down over $4 today, or a decline of over 3%. Obviously, that's our magic number, down 3%. So we are selling some spreads in both Salesforce.com and F5. F5, our levels are selling the 195 put spread, and Salesforce.com we're selling the 120, 115 put spreads. Both of those expire in February. In terms of F5, right, Verizon's looking for about 10 million iPhones being sold during the quarter. During the year, and an untold number of millions of iPads. Both of those bode well for a company like F5 because they make the infrastructure that we all need to have a bigger, better, faster, stronger cloud. And the idea of the cloud, the idea of network infrastructure is a secular trend. It's not going away anytime soon. I see more and more mobile devices, laptops, notepads, all of those devices coming out, which means F5 has a customer for long into the future, as long as they remain more competitive than their competition. Salesforce.com is the same way. More and more things are moving cloud-based, meaning they don't live on your machine itself. They're housed in a server somewhere, and you simply access them via the internet. All of this means we need basically more ways to access the internet, more reliable ways to access the internet, and faster ways to access the internet. All right. Taking a look at large positions like Cree, Deckers, and Molycorp, right? Coming in today, obviously having to roll down and out, especially at the last minute, often means that you have to increase your position size. So things like Deckers got a little big for February. What we're doing is looking out on the calendar in both March and June, and in some cases January of 2012, and getting the strikes down as far as we can. Deckers, we want to target that $70 level. Okay, Deckers ran from $60 on November the 16th, ran until about December the 20th, where it got just over $87 before it ran out of gas. A 55% Fibonacci retracement of that number puts the stock right around $73.50, which it's already trading below that today. It's about a buck below that. So the next level, a 66% Fibonacci retracement, actually puts the stock at $70.80. Hence why we want to be below that $70 strike. So we are looking at rolling down and out from February to the March and June 70-65 put spreads on Deckers. Right? The company reports February 23rd. That is before February options expiration. We shall see how it goes. Earnings have been good in some cases, like a Google, and terrible in other cases, like an F5. So it just depends on what side of the coin we find ourselves going into those earnings. All right, last week on Thursday, Brian Kelly made Molycorp, ticker symbol MCP, his final trade. There is a line of support in the stock at $46.11. The stock has jumped back above that key level of support today. So we are moving on the open. Before the stock ran, we moved some of our February short 45-40 put spreads of Molycorp down and out to March and June 40-35 put spreads. So if the stock stays above right where it's at, $46, we would all be extremely happy, and all of our trades would be out of the money and expire worthless. We shall see how this goes. I've got to read the news on this. There's some talk about more stock being issued. I've got to take a look at it before I have some more details, but I know that there is news out on the wire, and that's why Molycorp is jumping so much. But we do like that. If we can get under that $40 level, we're extremely comfortable being short 35 put spreads in MCP, and that's what we're going to look to do. The moral of the story today is that we're taking big short spread positions like a Deckers, like a Cree, like a Molycorp, and looking further out on the calendar for both March, June, September in some cases, and then January of 2012. Getting as low as we can. In some cases, if you go far enough out on the calendar, you can actually make your position smaller, not larger, and that's good. It means that you're going to be in the trade for longer, but you should, if you do it right, you should take an additional premium, or if nothing else, do it for flat. meaning you're just going to exchange the spreads you're short for being short spreads at a much lower strike in a bigger position, which ultimately means you're going to take in more money when those expire. All right? We've got a ton of cash after the sale of lots of stock from last week, and spreads like Lululemon, Apple, and Akamai all went in our direction. Yay, right? It was not a total loss. We did have some really good expirations for those three names and a couple others, but I have to go back and look. So stay nimble. Don't put on all of your February positions just yet. This is about the time in which the indexes rolled over, right, before they bounce going into April. So be careful, stay nimble, keep your position size small, and if you have spreads that are horribly going against you that you had to roll out, like Cree, right, if you're short 55 and Cree's trading at 51, you probably want to already start looking out on the calendar so that there's plenty of time value, right, in the spread that you have on right now that you're short. All right, thanks for joining us again today. Have a great day, and we will see you tomorrow.